So house prices took a dip. Is this the bubble just about to pop? So in this video, we're going to discuss what's going to go on in the housing market. We've got loads of headwind coming against us with crises, wars, money printing, loads and loads of stuff going on. So in this video, we're going to share with you the first dip and first signs of a crack in the property market. And is this sustainable? Are we going to go into a big downward spiral with property prices? But the first thing what you want to be putting down is your thumb on that like button, so you help out my ego and you also help out the algorithms. So Halifax released a house price index. So if you watched my last video talk about the housing market, I've done my report from Rightmove on the housing market update. That gives you average asking prices. Halifax give you sold prices. Between Halifax and Nationwide, they give you really accurate predicted prices on what's going on in the market. Halifax obviously get their data from mortgages and the stuff they're lending to. Rightmove get their data from sold prices on their platform. They don't know asking prices. They don't know actually what they sold for until they come through from land registry. So Halifax have got their finger on the pulse pretty good because they're at the front end of lending and a large lender in the UK. But average houses prices fell just slightly, but it's a first drop in over a year and it dropped 0.1%. So it's not significant in the grand scheme of it. This could be a seasonal drop as well. Usually in the summertime, when people are going on holidays, when parents do not want to move homes, when it's hot, when kids are off of school, there is always a seasonal drop around this time of the year. So is this going to be a seasonal drop, or is this going to be the start of this bubble bursting that we've been in and this really expensive house prices? Because look, the typical UK property costs £293,221. That is absolutely bonkers. When you look at the average UK salary and compare this to the average UK house prices, this is a price per earning ratio. Look, depending on what site you look on, they all differ between it, but it's around the 30k mark. On this job, I don't know how you say that, but it's jobted.com. Bit dyslexic, apologies anybody for that, but if you look on here, it says £29,600. So then when you think you need most banks will lend a 4.5 times multiplier of your income. This is definitely putting more and more pressure on the average house prices. As I said, look, I talked about it in my last video. You can get that in the links below. I'll give you a suggestion I know you want, but if you don't want to jump off now and want to watch the rest of it, which I suggest you do, look in the description below. You'll get all the suggested videos below so you can watch the end of this. But if you want to speed to it, check out that video here. So to buy the average home for 290 odd K, you're going to need 29k on the average deposit, which is 10%. You're going to need a 29k deposit. That means you're going to need to be able to borrow 261,000. So that means you can only borrow on a average salary £130,000. So the average properties are not, like the average salaries are not meeting with the average properties. Unless you are getting married and you're in a partnership, then obviously you can combine your income. But not everybody's got that, but not everybody, shock horror, lasts in partnerships, and you cause a whole world of complications when you do that as a partners. That's definitely for a video for another time. But what does all this mean for us property investors? So again, this case scenario is even worse in London. You know, you watch this video, what I talk about is London crashing. London is stalled. When you look at the price growth, it's not an average price. London's, in some reports saying it's just over 500k, some reports saying it's close to 600k. Whatever it is, it's a wide earnings per earnings ratio. As I said, I've done a video on this, or you can catch it in the comments in the description below if you want to watch this full video, come back to that. But London's average salary is around 39,000, only 10,000 above the average salary of the UK. Then the average salary in the average house price is over £500,000. Again, you do these same sort of multipliers, you can see why London's already stalled. And as the average price is going up and up and up, this is why I feel it's got vulnerability to be installed again. Or is that how you say that? Or it's vulnerability of stalling. It's getting a bit tongue-tied with that. But again, this is why I'm talking about a massive wealth transfer. The wealth is transferring massively to areas where the price per earnings ratio is more affordable. I won't go into too much depth here. I know there's a lot of videos I'm suggesting, but have a look at this video. Again, it's going to be in the description if you want to carry on watching, or you want to fast forward to that now, jump on and watch this video about the biggest wealth transfer in property wealth seen in our generation and maybe in a lifetime, because there's never been such a wide gap between the north and south when you look over the previous history of London and the house prices of the north. But as I said, what does this mean? Are we going to go into a crash? What is going to happen? Zoopla, I'm not going to give you my suggestions on this. I've given it on plenty of other videos. But I'm going to tell you what I feel we should do at the end. But Zoopla has a massive database of information. Again, another big platform. And this is what their thoughts are on the markets at the moment about crashing or not. So will there be a crash? And they've said, we never say never, but no. We don't think there will be a housing crash. Double-digit falls in average prices are highly unlikely, even though we face a higher mortgage rates and increased cost of living. House prices only tend to fall when there are forced sellers. That's people who can't afford their mortgage and have no option but to sell. But in the UK, less than half of the homeowners have mortgages, and 85% of those who have a mortgage have a fixed rate for 3 to 5 years. This installs the market for a short-term, insulates the market, for short-term changes in mortgage rates. So they've been stress testing, and a lot of people want a fixed rate. There is a percentage of people on variable, but it is small in comparison to the ownership of properties in the UK. And this is why Zoopla believe we're not going to get a major correction or a major fall. I agree with them. I don't feel we're going to get major corrections and major falls, but I feel we're going to get, correction and a major crash are two different things. A slight correction is when the price is slightly correct, and a crash is when they crash. Since the 1930s recession, the Great Depression, we've only had two major crashes in the property market, although we've had lots and lots of recessions. Because what often happens when we have a recession, it's often not the property market that we're having a recession for. It's to do with the stock markets and the economic stuff that's going on in the bigger economic picture. Getting really tongue-tied today. But properties is a safe haven, a safe bet for investors. So in these times, a lot of people end up getting into gold or property because it's safe asset classes. So the property market usually softens a little bit. Banks don't lend as much when the economic times are uncertain in case people lose jobs, but it usually softens or slightly corrects in most recessions we've had. Do I feel this recession is going to be the same? We are technically in a recession, but do I feel like America are technically in a recession, and all the indicators are showing the global recession is on the cards? But do I feel this recession is going to be one of those recessions we're going to get a major house price crash or just a potential correction and a slowdown? My views is a correction and a slowdown, but there's microeconomics within this. As an average, we'll get a correction and a slowdown, but some areas I do feel are much more vulnerable where the price per earnings ratio is wider, and some areas not so vulnerable, like what I'm going to share with you, how you invest in these sort of times and why I invest remotely in areas where the price per earnings ratio is in line and the average property prices are in line with the average wages. But go back to this Zoopla article as well. We said we have already toughened affordability checks for buyers. History shows that falling house prices tend to be predicted by looser lending standards. So again, the banks have been lending really tightly. They have lifted this affordability check, but they feel if you can meet they've not lifted the multiplier of income. So they feel if you can afford that, they're lifting that. From my opinion, I've said this in previous videos, I think that's more of a sentiment thing. They don't want people worrying and not buying houses and locking up the house market with these interest rate rise. In the grand scheme of things, the interest rates risen to 1.75% is not historically high, and it's not massive anyway. So I feel the more damage, there is going to be damage to some people. The average mortgage is going to jump from £800 to over £1,000, but the more that damage is going to come from the sentiment and people worrying and then freezing, not buying and selling houses or moving on. Or some people are in a 5-year fix thinking, well, I don't want to jump out of this fix now, so I'm not going to move. But it depends what articles you read. Some articles say we're going to crash and it's doom and gloom. Some are going to say we're still going to grow. Frank Knight have rechanged the beginning of the year prediction of 5% growth over this year to 7%, even in the face of all these economic worries. But then there's other articles say it's going to drop. So what you want to be doing is not thinking about what you want to do some research. You want to do some understanding what's going on in the market as a whole, but do not base your decisions on what you think the market's going to do based on fundamental investment property decisions. And how do you make the decisions? I'm going to share with you now. So look, I'll talk about the property delta matrix, and this is basing it on this. So depending where you are on your journey will depend on what sort of properties you want to be going after in this climate. You don't want to be relying on the market growing. You don't also want to be relying on the market crashing. By the way, in crashes, there's lots of more opportunity to buy good deals, but they're harder to fund because the banks don't lend so easy. But ask yourself the question of where you are on here. But this is a wealth. This is, forget like property with rent to rents, forget property with deal sourcing. This is owning assets, and now you build a wealth foundation of owning assets. And if you've got multiple streams of income from these assets with buy-to-lets, HMOs, SAs, commercial conversions and developments, then that's when you're going to be safe. But to make sure you go for the right opportunity for the right place where you are on your journey. And you'll find that out by asking yourself 0 to 10 where you are on all of these. So think about it. Knowledge. How much money do you have? 0 to 10. If you've got a lot of money and a lot of buffer, you can go for the commercial conversion, because if the banks recall their loans or down value, I just got down valuation on a commercial valuation, and if they start recalling that, you're going to have the buffer under here of these sort of stuff to give you the income to fight yourself out of this stuff. Because if it's your first deal and you're doing commercial conversion and the banks recall the money and you've not got the money to pay it back, they're going to give you, make sure you've got a personal guarantee on it, and they're going to start taking your other assets or your homes and things that you're personally guaranteed on that. So think about, again, next, your knowledge. So what sort of knowledge you've got? The further you go up there, the commercial conversion developments are much more difficult. I'm not advising most people to do developments, the time it takes you through planning, even stuff with planning gain, the time you go through it with inflation and the cost of labour going up, the cost of materials going up, loads of changes and the vulnerability in the market. A lot of people work off 20% margins. So let's say you've got a 20% margin and the prices dip 5% in your area and the inflation and cost of labour goes up 5%, you have to squeeze that out 10%. So now your margin is really, really, really low. So your exit might not be there, and your exit might be to sell, and you can't rent out these. And if that is the case, if you're going to sell or flip properties in this market, make sure you can exit them by renting as well. So don't just rely on the market. You don't know where the market will be in 6 months, in a year's time. You don't know what other forces, with all these conflicts in the world going on, you don't know what's going to happen for sure. You don't know what the banks are going to do for sure as well. They might go on another printing spree of money and put loads of money into the economy. We just don't know. Or they might just really force up the interest rate and really try to, they've got a choice between causing recession, putting the interest rate up, or massive inflation and cost of living. As I said, I'm not going to go too deep in that, because in the description below you'll see videos I've done about that already. But the next thing you've got to ask yourself as well is how much time you've got, a network. So look, if you've got a good network of builders, of accountants, of solicitors, you can go further up. If you've got good knowledge, you can go further up. But if you've not got that, start on the simpler stuff, cut your teeth. And there's a final one, I'm not sure if you can see it down here. It's called CCC, it's courage, confidence, conviction. Look, you could have all the money, all the knowledge, but if you haven't got the conviction and the courage, you've got to start lower and get that momentum, because the courage and conviction and confidence come with doing it. And if you're getting overwhelmed by doing these bigger projects, which they are much more overwhelming, just start on the smaller stuff to get that momentum going forward. The next thing you want to do to make stern investment decisions is make sure you protect the downside in what you're doing. So what I mean by this is, can you afford, if you're on a bridging loan and it goes over time, can you afford to pay that bridging loan? Can you exit it? Can you afford to raise the finance to pay back your investors if the banks don't want to lend you or they downvalue this stuff? Make sure you protect the downside. Make sure you stress test it correctly, like interest rates rising and going up. Great way to stress test stuff. I recommend this all the time. They're great company is Landlord. You can put the figures in Landlord. We'll put a link below for Landlord. You can put the figures in Landlord and it'll tell you some stress tests and the future stuff, and you really get an informed decision around this. What you want is properties that give you cash flow. The thing with the gold, I just bought some gold myself, and the thing with a lot of other asset classes, they don't give you cash flow. Cash flow is king. Cash flow is what's going to pay your holidays, your extra cost of living. It's going to pay for everything. So as long as your cash flow keeps coming in, you fix it for a long period of time, you're gonna ride through these markets. So do this advice, make sure you get stirred, like, assets that can handle a rate rise, get assets that are fixed for a long period of time, get assets that give you strong cash flow, and get assets in line with where you are in your journey, with your experience and your cash you've got available. And you will not only ride through this, you'll not only survive and ride through this, you will actually thrive for it, because you've got more opportunity in these markets. And there's loads of cash out there at the moment to raise private finance, because a lot of that money will come into the property market. So if you position yourself well and you do what you're doing well, this will give you massive amounts of opportunity. But as I said before, You can't time markets. Time in the market's going to beat time in the market. Take this advice. Watch this video. It'll be in the link below. But listen, my why is to live my own terms. My mission is to help as many people live on their terms using property as a vehicle to do that. So please share this out. Please, if you've not done it already, hit the subscribe button. Hit that bell icon so you get notified every time we do videos like this. Also, give it a thumbs up if you didn't give it that thumbs up on that first little cue. And yeah, tag people in if you think they'll get value from it. But listen, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day.